logistics of these policy illustrations. So in my last video, we went over a few terms: the MEC limit, term rider, dump-ins, base premium, paid up additions rider. So knowing those terms will help you within this video because I'm going to go a step deeper. Okay, so up on the screen, I'm going to show a few illustrations, and really within these policy illustrations, there's a page on them. Now, within the different companies, they're called different things. For instance, Lafayette Life, it's called the additional information page. Within Mass Mutual, it's called the narrative summary page. Within One America, it's called the itemized premiums and benefits page. Within each company, they're going to be found just in different places within the policy illustration, but they're still all there and still look very similar, and you can diagnose exactly how your policy is designed and made up when you find this page. So first I want to touch on this policy illustration, and I'll show it up here on the screen. So this is a whole life policy designed for this banking concept. And the reason I chose this policy illustration is because it has a base premium, paid up additions rider, and it has a dump in as well, along with a term rider. So I can show you how this is going to look. So this page can be found within all policy illustrations. So your policy illustration has this, whether it be with Lafayette Life or a different company. Okay, so you can find how your policy is designed and created. Okay, so for this one, for instance, so this individual, they're putting in $500 a month, and they're going to do a first year dump in of $22.50. So I'm going to look here underneath my premium information. You can see that there's base policy, 7-year term rider, and level premium PUA rider. Again, PUA stands for paid up additions. So you can see that the coverage amount is the same thing as death benefit, same thing as face amount. All of those terms mean the same thing. So this is actually breaking down how much death benefit is coming from your base premium, how much death benefits coming from the term rider, and how much death benefits coming from your paid up additions rider. Because your paid up additions rider, main objective is cash, but it does give us a little bit of death benefit as well. In this policy illustration, we're putting in $200 towards the base. Right? $200, that's 40% of $500, that goes towards our base premium. For the paid up additions rider, you can see it's a shy under $300. So $300 would be our 60% going towards the paid up additions rider. But because this individual wanted to put this dump in onto the policy, for instance, within Lafayette Life, it's called the single premium paid up additions rider, $22.50, as you can see right there. This is their dump in, and in order for this dump in to fit inside of this contract, we had to add on a small term rider. So you can see here, this individual is paying about, we'll say $550 each month towards this term rider for the next 7 years to fit this dump in onto the policy. Okay, so for instance, this is a Lafayette Life one. I'll shoot up here this is what a One America itemized premiums and benefits page look like. Similar, right? While I have the One America policy illustration itemized premiums and benefits page up here on the screen, I want to talk about the 3 riders that are here within this contract. So these riders, you can see that they're free of charge. It's called the terminal illness rider, chronic illness rider, and index dividend crediting option rider. And we'll talk about these. So terminal and chronic illness rider. All insurance companies that we are affiliated with, they have a terminal chronic illness rider. Now these riders, they're free of charge. So we put them on the policy. So basically what happens is that if you ever come to a terminal, meaning that, hey, you have less than 12 months to live, or you have less than 12 months of life expectancy left, the insurance company will start paying off your death benefit early to help with medical concerns. Same thing with the chronic illness rider. Chronic illness rider means that you cannot perform 2 out of the 6 daily activities of living. Bathing, eating, walking, right? Just to name a few. Getting dressed, just to name a few. The chronic illness rider is the same thing, right? Because you have that chronic illness, the insurance company will then again start paying off your death benefit early so you can use those funds for medical expenses. Now, the last one on here, it really just pertains to One America, the index dividend crediting option. I get this question a lot if you are with the company called One America. And basically all this is, it's just a dividend. How we design dividends is we design the dividend to go back into the policy, purchasing us more paid up additions rider. Right, goes back into the policy, starts earning the uninterrupted 4% compounding, and thus it just gives us cash that we can then take out in the form of a loan to start doing X, Y, and Z with it, right? So this index dividend crediting option, it's just a rider, it's free of charge, it's added on to all whole life contracts, and basically it's just giving you the option that if you wanted to allocate a percentage of your dividend into an investment category that One America is providing, whether it be the S&P 500, the Dow Jones, whatever you choose, you can allocate a percentage of your dividend to go into there and thus maybe get a greater return on your dividend or not so much of a great return, right? So it's really up to you if you want to choose that option. My encouragement for that, if that is something you want to do, just call up policy servicing. Tell them that, hey, I'm interested in this index dividend crediting option. Can you tell me a little bit more about it? How can I do that? How can I allocate 50% of my dividend to go there, right? So, however, my advice, I don't do a lot in the stock market personally. I'm more into guaranteed, safe, sound investments. And my joke that I make is I say, hey, put your money in the whole life policy, start earning the guaranteed 4, then go out and take that loan and go invest it in the stock market, right? So really up to you. That's just what that rider means. I'm gonna flash up the Mass Mutual one, the narrative summary. Here, I want to touch on a little something. So this page, you can really see, hey, who is the individual? What is their underwriting class, health class that they have, right? What's your MEC status? What's the dividend option? I'm more concerned with the premium information and the coverage information in the middle of this sheet. One thing I want to point out is Mass Mutual is a little different. So if you see here on this particular illustration, this individual is putting in a total of $49,000 of premium within the first year. Now, you can see that they're doing $25,000 of a dump-in. It's labeled underneath there the ALIR, unscheduled first year lump sum. That is our $25,000 dump-in this individual is doing. And along with, you can see their base premium, along with their ALISR premium first year. Now, what is an LISR? I've never heard of that before. And honestly, that is just Mass Mutual's fancy terminology for the paid up additions rider. So LISR, it means life insured supplement rider. And again, it's just the paid up additions rider that this is that crucial aspect to make this function for this banking concept. Now, I'm going to move on to the fourth company, Ohio National. Now, a few of you have policies with Ohio National, great company. Ohio National doesn't really list out the base premium, paid up additions rider, dump-ins, and all of that jazz. What they do is they actually have written sentences and telling you, hey, this is what this means. And honestly, if you're an analytical person, you'll like this. All right. So I'm looking at a policy illustration here, and I'm just looking underneath the optional riders tab. So it's a few pages down in the illustration. And for instance, so this individual, they're putting in $25,000 a year. Okay, so of this $25,000 that they're putting in, you can see on this particular product with Ohio National. So the products that we're using right now, and they're at this date and time that I'm filming this. This is 2020, and we're on the 2020 CSO mortality tables. So this is a new product that came off of those mortality tables. Now, on this policy illustration, this individual is putting in $25,000 a year. Now, as you can see here, you can see there's the terminal illness accelerated benefit rider, which I explained earlier. Same thing, terminal illness rider. And you can see that there's a plus rider here. So here, this individual, they wanted to put in just a little bit more into their paid up additions rider compared to their base. Meaning that instead of a 40% to the base, 60% to the paid up additions rider split, they wanted to do a 30 to the base, 70 to the paid up additions rider split. Because reminder, we always will suggest ideas to y'all, but you are in the driver's seat when you're working with us. So we will design the policy however you want, but we're here for help and guidance and getting you what you want, okay? So for this instance, because he wanted to enlarge those splits, we had to add on a term rider to this policy. And so actually this product with Ohio National is pretty cool. It's a blended term whole life policy. So you don't really have to quote unquote pay for that term rider. It really goes incorporated into the full total premium that we're doing. I hope that makes sense. But anyways, for instance, so on this page, as you can see here, it'll go into depth of what this term rider is, how much death benefit you're adding from this term rider, and how long this term rider is going to stay on the policy, i.e. when is it going to expire and fall off, at age what, right? So, and then underneath of that, you can see level paid up additions rider, level paid up additions, right? That's our PUA. In here, you can see how many dollars are going towards that paid up additions rider and how long it's staying attached for. Now, the only thing that's really different with Ohio National is it doesn't list out how much we're putting into the base. How much premium are we to put into our base policy? And so really to figure that out, we just take our full total premium, our $25,000, and we subtract the $18,250 that it's telling us is going towards the paid up additions rider. That total that we get from doing that equation is our base premium. That's how much we're putting towards the base premium. So again, I stress, I look at the illustration, I look at the tabular values, tabular detail page, and that's really where I base a lot of my numbers on. Yes, I do think it is important that you should go and see how your policy is designed and acted and is operating, and thus then you'll kind of understand, okay, if my policy is designed this way, I understand that my numbers are going to play out this way within the policy illustration. So let's talk about the tabular details page, the tabular values page, right? This to me is the most important part of the policy illustration, because this is exactly where we pull the numbers from. This is exactly where we compare and contrast certain illustrations from one company to the other, or different premium amounts, or different splits and how the policy is designed. Go to that tabular details, tabular values page. You are able to see the guaranteed side of the policy along with the non-guaranteed side, right? So recap, The guaranteed side of the policy illustration is this is the worst thing your policy can do, is what I say. So that is that contractual 4% guaranteed growth on our cash inside of the policy, compounding, right? On the non-guaranteed side, this is the guaranteed growth plus the projected dividends the insurance company is thinking about paying out that year. Okay, so let's talk about this, right? Dividends are all the companies that the Money Multiplier is affiliated with. Are they direct recognition companies or non-direct recognition companies? All right, and what does that mean? What is direct versus non-direct? So we prefer, and Nelson Nash says that you want a mutual company, a mutual non-direct recognition company. And what does that mean? What that means is that even though you have an outstanding loan on your policy, your dividend will not be affected by it. Your dividend will still be paid out as if that full loan amount is still in your policy, growing and compounding. So that is why when you are looking for certain companies to be affiliated with or to want to work with, we encourage you to work with non-direct recognition companies for that reason.